Welcome to TheoTrade. This is Don Kaufman. July 8th, 2022, doing the TheoTrade weekend update on a Friday afternoon. Will summer trade bring down some of this extreme volatility we have been seeing? Obviously, we're just exiting what has been a holiday week of trade, right? Monday's 4th of July, S&P and equity markets, index markets, bond markets closed. And right out of the gate on Tuesday, we hit the lower edge of the expected move. Let's jump right into it with just a brief review of some of the price action in this previous week of trade. As I was saying, right out of the gate on Tuesday, we came within 4 points of hitting the lower edge of the S&P expected move. Expected move this past week was about $94 in change. But the interesting irony and twist to it all, just 4 days later, we actually hit today the upper edge of the expected move. In fact, it is worth kind of exploring in this particular circumstance, even some of the intraday trade. For those of you not familiar with expected move, well, get familiar with it because that, people, is spot on. A few pennies off the upper edge of the expected move. Now, think about this, if you will. And one of the most critical aspects that I really want to focus on in this weekend's update, and I'm talking about summer trade and bringing down volatility. And inevitably, everybody's immediately going to look over at VIX and they're like, well, Don, the volatility is already coming down. I would agree. The implied volatility, and that is the VIX is forward vol. It's 30-day forward vol. Yeah, but nobody told that to the SPX, because taking a look at the SPX, it's not too often in any week, even in the midst of some, well, really extreme moves that we've seen as of late, to hit both the lower and upper edges of the expected move. So consequently, we're talking about, summer trade, it's the summer doldrums, as a lot of traders, of course, will make commentary on. But in reality, you just went $94 lower, okay, turned around, got back to even by the next day, and then ripped from there $94 higher. So, hey, what's 180 S&P handles amongst friends? That, by no stretch of the imagination, okay, is bringing down volatility. So there's this disconnect in markets right now, and it's one of the areas that, people, they constantly ask me, what kind of keeps you up at night in the marketplace? How about when realized volatility, that is, if you will, actual price movement in the marketplace? This week is pricing in like a $94 move. Actual price action from low to high, it's again about 180. That's the kind of stuff that should keep you up at night, no matter what strategy you might be deploying. All right. Again, the marketplace is not doing a good job of handicapping forward risk. Speaking of some of the expected moves out there, and again, the expected move is the option market. It's how the option market is kind of depicting risk. I think it's, worthwhile coming over to the QQQ from time to time. What happened inside of the Qs this week? They actually broke to the upper edge of expected move, but we're going to discuss that here just momentarily. All right, moving onward and upward from there. So let's actually talk a little bit about, non-farm payrolls. NFP comes out. The number is good. How good? 372, expected 268. So we smashed to the upside, okay, of even the wildest expectations in the jobs market. So again, 372,000 jobs added in the month of June. And you look at this and you're kind of scratching your head. That's why I have the headline up here: good jobs numbers gone bad. You have to start to rationalize what this amounts to for markets. In fact, Let's take a look at intraday trade. An intraday trade, if I zoom in precisely when the job numbers came out, the reaction, S&P sold off. Pretty good as well. I mean, have we seen more volatility in recent times? Of course we have. The S&Ps prior to the jobs number trading, 3,900. They touched down just 15 minutes later to 3870. So, and about 30 S&P points plus in about 15 minutes time. So why would good numbers be bad? Because it's all engines go then for Fed. Reduction of balance sheet, quantitative tightening, probably looking at another, as the Fed said in the FOMC minutes, anywhere from 50 to 75 basis points. But you have to understand that we're kind of walking backwards, if you will, into this recession. And ultimately, good jobs numbers, it's, as I said, it's just going to, give more fuel to the Fed to hike. I mean, hike away. Come on, jobs are decent out there. And the marketplace rationalized this in a number of ways. One of the first ways that you're seeing the market, when I say rationalized it, again, the S&Ps initially sold off and they rebounded a little bit, but the S&Ps finished massively unchanged on this Friday afternoon. But some of the rationale came by means of the bond market. If you're looking at the bonds, they've actually been rallying lately. Okay, and okay, so they've been rallying a little bit, not a problem. That means rates though are coming down. Well, all of a sudden, I think that rate fears, and when I'm talking about rate fears, let's go to the TNX. That's the 10-year interest rate. And the 10-year interest rate, it's right here. Okay, so just mark it in your head. It's very roughly about 3.1 right now, 3.1. I believe that, well, simply because good job numbers have come out, right? That's going to be all engines go for the Fed, which is going to lead once again, rate fears, here we come. Just when you thought that, you weren't hearing much about interest rates, I think we're going to hear a lot about it again. As I've said in the past, I believe that this entire summer is what I call the merry-go-round, okay, of like horrors. We're gonna go from, what? We were talking about supply chain issues, then we were looking at oil, and oil was an issue. Then all of a sudden, interest rates and an inversion of the yield curve, recession fears are coming around. Yeah, well, now with good job numbers, it's like a big reset. And we're talking about, well, interest rates then are going to explode back to the upside. This is, again, the merry-go-round of risks. I would look for continuation at this point in bonds sell side activity. And if that is to continue, like again, when I'm talking about rate fears and the Fed, and people get a little bit lost in the weeds, what does it really amount to? It amounts to tech selling off again. I mean, higher rates is just not good for tech. And we're actually looking at a symbol, it's a conglomerate symbol called the monsters of tech. Everything from Microsoft to Apple. You got to look again at the underlyings that stand the most to lose. And one of which is, again, it's been on the dance floor for me for the last couple of weeks. I've been talking about this. I would watch products like Google very, very carefully. Again, if interest rate fears kind of reignite, Google, which actually had a fairly stellar week this week, would actually be up to the plate for some sell side activity. Obviously, Google going through a split in the very near future. And of course, earnings coming out towards the end of the month of July. Nevertheless, it's a big issue at this point. When you have good job numbers in an economy that ultimately is, interest rates being hiked and inflationary, okay, again, it's just pouring more fuel on the Fed fire to do everything they possibly can to curb inflation, because good job numbers is not necessarily a good thing for inflation. All right. Another front over here, this is one of the more interesting trades of the week as well. Oil had absolutely collapsed earlier in the week and then rebounded. And what is so interesting about it is what is being denoted here, okay? Oil, huge sell side activity. I mean, literally traded in a range from 112 all the way down to 98. Okay. But net is down, just shy of about 10% in one trading session. The reason I am bringing oil up is it's very similar, if you will, to the discussion of rate fears being kind of reignited. And with oil collapsing, that was simply because, imagine this, if you will, on Tuesday of this week, okay, we're looking at economic slowdown. It's going to be ugly out there. The economy is slowing down. All right. The need for energy is decreasing. Oil collapses down. Okay. Meanwhile, by Friday of the week, jobs numbers come out. Everybody's high-fiving one another. It's a complete and total rebound. The economy maybe is not doing as poorly and could sustain more rate increases. All right, so it's one of the reasons I just wanted to bring up oil is, again, not so much the trade in oil, but I think it furthers this entire idea and the logic similar to the bond marketplace. All right, so in this coming week of trade, bonds are going to become pivotal. All of a sudden, they haven't really played that much, okay, of a critical role. And when I'm talking about a critical role, I mean bonds have meandered a significant amount as of late, channeled back and forth. But this recent rally in bonds, maybe some of the sell side activity was overdone, but this recent rally in bonds was actually indicating much more of like stagflation or even deflation, if you will, whichever way you want to call it. And then again, we're 3 days later, now we're talking about rate fears igniting again, which does not bode well for technology. All right, another complete spin around over here, taking a look at dollar. So did the dollar just peak out earlier today? Some very, very tumultuous, volatile trade inside of the US dollar. Okay, this is one where, quite frankly, I got more questions than answers. Okay, watch dollar carefully this next week of trade. I mean, for the most part, what we're seeing is currencies around the world ultimately being devalued versus the US dollar. I mean, the baskets out there, it's hideous. It's just absolutely hideous. In fact, again, I was talking about the euro versus the US dollar, and that there's a lot of traders that haven't seen, all right, the euro, okay, at the exact same price, basically at par with the US dollar in their lifetime. All right, so I'm going back 15 years and you haven't seen the euro this low. You've actually got to open up a maximum chart. The last time we actually saw price action like this is over 20 years ago. So it is really worth noting the move that we saw. And the reason I bring this up, okay, I think that the dollar and the move into the dollar speaks volumes about the risk, okay, that markets are sustaining around the world. Everybody's like, let's get out of the euro, let's get out of the yuan, let's get out of basically every currency. The Japanese yen, I mean, the Japanese yen, it just cannot catch a break. Well, today's trade, again, I don't have a definitive answer for you, but it did absolutely look like a big reactionary kind of high. And we pivoted significantly lower off of there. Got to watch this trade carefully, because if the dollar continues to rally, it's not going to bode well for the rest of the marketplace and the entire second half if this dollar continues to rally. All right. Energy and financials are going to continue to lead. I've mentioned this extensively in much of recent trade, but be on the lookout again on a day-to-day basis for movement inside of the financials, for movement inside of the energy sector. It's just been a really long time, okay, since we've had the financials kind of being the leader in the pack. Moreover, okay, earnings are coming and the financials are due up starting late next week. When it comes to the energy sector, okay, the energy sector, I prefer to pull up XLE specifically for this, still up 24% on a year-to-date basis. Now, do not in your mind couple the XLE, which is the energy sector. It's your Exxon Mobil's and your ConocoPhillips. Don't couple that per se with the price action in oil. And the reason I'm saying that, okay, take a look at the energy sector throughout the course of this week. It doesn't look anything, okay, not even resembles any of the price action of oil. Nevertheless, okay, why do I believe it's going to lead trade? Because the market capitalization of energy plus financials, okay, pretty much is right neck and neck now with some of the bigger tech companies, right? So we've seen again some of the huge mega market capitalizations get demolished. There's no question. Firms like Apple, okay, it's still completely ridiculous how significant in terms of the market cap, an Apple happens to be. Nevertheless, again, financials plus energy is absolutely critical. As I said, earnings are here, and that's going to be a big mover. So if we take back a quick look at the XLF, you're going to look at this next week of trade, and the irony of this is if you look at the ETF, you're like, wow, volatility is really jacked up, and there it is. Why? Because earnings are coming. The earnings are actually staging quite the little move in terms of volatility in the very near term inside of the financials. And that can, again, it can move the entire S&P 500. Do not forget it this next week. I mean, for a summer week of trade where people are like, we're going into the summer doldrums, there's so much to look at. We got to keep an eye, obviously, on bonds. Bonds continue to sell off. It's going to start to hammer tech. Okay, you got to watch the dollar. If the dollar starts to rally back, okay, that could be a signal. Well, markets all over the world are still going to continue to get hit. Okay, obviously people want to key into the S&Ps, but the S&Ps at this point, okay, are just reactionary to a lot of what's going on again inside of the bond market, inside of the dollar. Right. Last but definitely not least over here, we've got to have a discussion a little bit about still a very, very low VIX, low VVIX, low SKEW. So the VIX itself has once again come down. We're in a 24 to 25 VIX. That is not that disconcerting. The disconcerting area is things like VVIX. Okay, when you have to pull up a 3-year chart on VVIX, there's nothing in 3 years. We have to pull up a 5-year chart on VVIX to see anything, okay, this low. And this is the volatility index. Once again, it signifies that the professional side of trade is not hedging. That, coupled with an incredibly low SKEW, also signifies the professional world is not hedging. Okay, it lends itself to considerable risk to the downside. That risk remains. So this is something I've talked about extensively in last weekend's update. Stop looking at VIX to try to handicap the forward future. Stop looking at like implied volatility. I'm telling you, the implied volatilities are low versus actual price action in the marketplace. Okay, it just is. And when you're talking about, will summer trade bring down volatility? Yeah, implied volatility is down, SKEW is down, VVIX is down. But the point that needs to be taken from that, okay, when you're looking at something like spiders and you're like, well, he's talking about like some lower volatility, maybe a little summer doldrums. To me, it all always comes down to risk reward. What a low VIX, a low VVIX, a low SKEW, okay, again, the signature of that is that the professional world is not well hedged. Okay, now that is not, okay, supposed to be construed as directionally biased. I'm not telling you whether we're bullish or bearish in that. I'm just saying, listen, hey, professional world, they're not out there buying calls in the VIX, because if they were buying calls in the VIX, tell you what, the VVIX would be higher. They're not out there buying puts in the SPX. You want to know why? Because if they were buying puts in the SPX, guess what? The SKEW would be higher. The VIX itself is rather low. So there's nobody reaching for puts, nobody reaching for that like insurance policy against the market right now. And the problem with that, if we do sell off, we sell into the abyss very, very rapidly, because firms would have to dynamically hedge. That means they would have to actually trade, okay, with the dynamic of the marketplace. So imagine if the marketplace started to sell off, big firms are going to sell into the selling. okay? And by then, it's too late. Get your game face on because there can be massive volatility seemingly out of nowhere in a marketplace with this low VIX, low VVIX, and low SKEW. Again, those coupled together, all right, they lend themselves to considerable downside versus, okay, a rather limited upside potential. It doesn't mean that we can't rally. It just means that upside potential, let's say, is 200 S&P points within, a week period. The downside of it, it's the abyss. This next week, we're looking at about a just shy of a $95 expected move. So volatility did in fact subside in this next week of trade. I mean, we just came out of a 4-day, again, we just came out of a 4-day trading week where we had a $94 expected move. This next week, okay, we have just over a $94 expected move, but it's a full 5 days of trading. And we have some very, very large numbers coming out. So this next week is going to be just, economic drops and what I call tape bombs. If you have no idea what that is, be careful on an intraday basis as the tape is going to get painted with lots of economic data and some big moves. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.